Well, this is what I'm watching, the Turkish Lira. So declining today, and the drama over the last few days has been about these local elections over the weekend. And basically, Turkish authorities want to prevent short selling. That has wreaked havoc into the market, whether you're looking at the offshore swap market, the bond market, the equity market, and other emerging markets. Joining us now, Marc Chandler, Bannockburn Global Forex managing partner. Is this going to be short-term until Sunday, or is this like a real shift here in the Turkish markets, Marc?
Well, I think the part is a shift in the emerging markets in general. So I think what's really captured our imagination about Turkey is just what you were saying about interest rates, like the overnight swap rates over 1,000%. But it's not even the weakest currency on the day, actually on the week. It's only down about 2 1/3%, while, say, Argentine peso down 6.5%, Brazil's down 5%, South Africa's down 3.5%. But what's going on is Turkey, like you were saying, officials are trying to, like, at war with the market, especially offshore investors. And so if offshore investors cannot hedge, and they're not going short, they're just trying to liquidate some of their assets or hedge their Turkish exposure. If they can't do that, what they're doing is they're selling Turkish assets then, rather than, if they can't hedge, insure themselves liquidation. Yeah. And that's what's jumping up interest rates. So they're 2 years up about 300 basis points this week.
So, Marc, you talked about the other currencies that are performing even worse. I'm wondering, how much contagion are you seeing stemming from what the turmoil in Turkey into other risky emerging markets currencies?
Yeah, I wish I could take you on that, like that. You know, this is an emerging market contagion story. But the real contagion, I think, is coming from the developed world. It's coming from the big drop in U.S. interest rates, European interest rates, because people, I think they're more concerned about growth and a global recession than is justified. But that's sort of like this huge momentum, and this concern that's a driving force this week is not so much about emerging markets, but the drop in G10 yields and the growth concerns, and that becomes more important for emerging markets than lower interest rates.
Well, fair. But how much of what we're seeing in Turkey, though, is going to be idiosyncratic over the next few days versus longer term? I mean, TD Securities says, look, the measures that they've taken are the closest to capital controls you're going to get. And if it works, why not just keep doing it?
So I'm with you on this. And so I think the hiccup is in the short term. But here's the long-term problem that they're burning the bridge for. Over the next 12 months, something like $180 billion of Turkish foreign currency borrowings are going to come due. They want people to roll those over, but what they're doing is sort of like what China did in the summer of 2015. By the government's actions, they're spooking investors for the long term. So even if officials win the battle in the short run, they've got this longer-term challenge.
Marc, do you think that Turkish assets are a buy because ultimately politicians and policymakers will reverse course and realize they need capital markets?
Yeah, I don't know. I suppose so at some point. I wouldn't want to do it with my money today.